Mortgage rates gone wild. We have both seen the lowest mortgage rates of the past month and the highest mortgage rates of the past month, all in the same week. In this video, I'm going to talk about this crazy wild week in mortgage rates, why mortgage rates are changing, and more importantly, where are they headed in the future. All right, Matt the Mortgage Guy, residential mortgage broker, powered by UMortgage, licensed across the country. If you want to connect me and my team, it's easy. GreatMortgageBroker.com, link down below. In this video, I'm going to talk to you about the wild ride mortgage interest rates have had over the last week, important data we have coming next week, and what I expect for the remainder of 2023, with a little bit of reasoning and simple man's kind of thought process behind it, right? So first and foremost, we had the Fed with their 25 basis point rate hike last week, last Wednesday. That quarter point rate hike was expected, nothing to see there. Jerome Powell's comments talked about disinflation. It was actually a good thing for mortgage interest rates, and mortgage rates reacted well, coming down, right? And then we saw a 5.99 on a 30-year fixed as a national average on Mortgage News Daily. Everybody was excited. Things are going great, right? Not so fast. Friday of last week, February 3rd, there was a jobs report. And our expectation on that jobs report, the JOLTS, job opening labor something, whatever the heck JOLT stands for, 188,000 job creations was the projection. It came in at 517,000. Blew out projections. And what happens when there's good, positive economic jobs data? Signals to the Fed, hey, listen, Fed, you can ramp rates. You can keep your foot on the gas. It's not affecting the economy. It's not affecting jobs. Look, unemployment's at all-time lows. We're creating jobs, 517,000 at a time. No need to stop what you're doing. You can do that, and it's not going to have effect over here. That's the signal it sends. And so mortgage rates react negatively. And we saw Friday of last week, a big jump. I'll show it to you, right? So check this bad boy out and look at the blue line. Blue line, 30-year fix. That's Mortgage News Daily numbers. So we like to look at that one. We were up in October and we were all the way, in the sevens. This was painful. This was tough for affordability. We come down and now we're bouncing around. We get to 5.99 and we're feeling really good. That was last Thursday. Between last Thursday and Tuesday the 7th, dramatic increase up to 6.45%. And that was mainly due to that jobs report. Today, as of me recording this video, Tuesday, February 7th, Jerome Powell spoke at some economic forum. Today wasn't a big mover, right? Today, I'll show you right here because I got it up. We're 5 basis points better for mortgage-backed securities. The 10-year treasury, up a couple basis points, but relatively unchanged. So not a lot of movements in the mortgage market today, but, over these last couple days, here it'll show you the daily number. Thursday, 5.99, Friday, 6.19, Monday, 6.39, and then Tuesday, 6.45. It's going to be in that same range, 6.4 to 6.5, when it comes out tomorrow. And so, this half a point is significant. I can tell you, as somebody who has these conversations every single day, that the difference between 6 and 6.5 is a lot of demand. That $100, $150, $200 a month, depending on loan size, difference in payment with a half a point increase in rate is significant. It's going to pull out, I don't know what the exact number is, right? But 10, 15, 20% worth of the demand, because people are going to be either unwilling or unable to qualify and buy homes, right? So enough about that. Let's talk about future projections. Piece of data that's coming out next week that we want to look out for, Valentine's Day, February 14th, good old CPI, Consumer Price Index, otherwise known as the inflation number for January. If this comes in low and it shows inflation is continuing to come down, very good thing for mortgage interest rates. And really, we've had 3 in a row, so it'd be 4 in a row. This would be fantastic. I had this thought today where, how can the market react so dramatically to one jobs report when these things get revised all the time? The way they measure it might be a little bit flawed. But yet a great inflation report comes in, they're like, it's only one report. Not really a trend, just one report. And then a second one comes in, well, it's only 2. It's not like we've seen, inflation coming down for 6 straight months, only 2. Like, how many of those do we need, right? We only needed one, like, really optimistic, great jobs reading to be able to, demolish mortgage interest rates. So anyhow, February 14th, CPI for January, that's going to be a determining factor, in my opinion, on what the Fed does come the end of March when they meet again. And they're going to either say, look at how strong the economy is and look at how strong jobs are, and let's just go 50 basis points. Let's make sure that we got inflation under control. If inflation shows a big decrease, that's going to counterbalance this jobs thing and just let them say, okay, cool, we're on our way. So February 14th, big important number, watch for it. That's going to have an effect on mortgage rates. One last thing I want to touch on. This is something that I think is relatively cool. I was talking to a buddy of mine. He's a prepay analyst for a big hedge fund, and they're looking at mortgage rates and how they behave and the history and all this cool stuff. In layman's terms, I just want to tell you that, like, it's no markets overview. It's no secret that this 10-year treasury and 30-year mortgage rates, they have a correlation over time, over history. I don't have that chart to show you the correlation, but I want to show you something, right? We're at 3.65 on the 10-year treasury. And generally speaking, you follow this, you can gauge what interest rates are doing. Currently, because mortgage interest rates are so volatile, the spread between the 10-year, follow me now, 3.65, and that 30-year fixed rate mortgage of 6.45, that's 2.8%, 280 basis points, right? Generally speaking, that spread is 180 to 200. My buddy explained to me today, you know why it's abnormally large, Matt? Is because the more volatile mortgage interest rates are, and they're really volatile right now, the larger the spread. When volatility subsides, when the Fed's got things under control and we expect that there's not going to be a bunch of manipulation and Fed intervention and things happening with interest rates, that spread is going to come down to the 180 to 200 basis points, 1.8% to 2% spread between the 10-year treasury and 30-year fixed rate mortgages. So what does this mean? Inflation comes down, the 10-year treasury starts to creep down. Let's say the 10-year treasury is down to 3%. And volatility is waning, is stripped out of the mortgage market. So we go back to a normal spread of, call it 2%. That's how we get to a 5% 30-year fixed rate mortgage. And that's where I think we're headed. So just my 2 cents, my thoughts, as an average dude who's following the stuff, looking at it every day. I'm rooting for you guys as home buyers. I'm rooting for you guys as investors. Affordability is an issue. 5% interest rates are going to ease some pain for some folks. So like I always say, we gonna see. Thanks for watching. I appreciate you. If you want to connect with a realtor in your area, homeandmoney.com/Matt. If you enjoy the content that much, then watch more. It's here, here, and here. There's 700 plus videos on here. There's got to be one you like.